Joining us now, former Federal Reserve Vice Chairman Alan Blinder. Alan, good to see you. Happy New Year. So a couple weeks ago, you thought the Fed won't cut rates until the second half of next year. You still feel that way?
Yeah, sort of, with a big cloud of uncertainty. I mean, you can't read these minutes without coming away with the view that the committee, taken as a whole, is very uncertain. That is to say, there are different views on the committees, on how soon rate cutting will start. But I think we can almost eliminate March based on what was in the minutes. So second half is not looking too bad, but it could squeeze into the first half, depending on data.
Okay. Is good news good news? I mean, after seeing the job openings, labor turnover numbers today, quits lower, hires lower, are things tightening up so much that you expect something surprising with this number?
Use the phrase tightening up. It seems like sort of normalizing. I mean, we've gotten used to getting very abnormal numbers out of the labor markets, like gigantic numbers of vacancies relative to people looking for jobs, super low unemployment, job
creation. Yeah, I should have said loosening up.
Relative to trend. We got used to that. And things are simmering down to normal, which is, first of all, inevitable, and secondly, I think is making the Fed happy.
Sure. So what's the most important number, do you think, on Friday? Does it have to do with wages versus just the raw jobs number?
I think it's always the payroll employment number. Wages are coming in second place in importance. I think there are lots of numbers there are lots of numbers on both, but the jobs number really sticks out. That said, I'm not expecting it to move the Fed very much unless it's either way higher than people expect or way lower than people expect. If it comes in the high 100s, which is where market expectations are, I think it's a yawn.
Just talking with Simeon Siegel about the cadence of the holiday season and consumer spending, such an important piece of this puzzle. Do you have any sense of how either the market might react or even what the Fed is looking for in how the back end of the holiday season might have played out? We saw some strength in the front end.
I think the Fed is, the easy answer to your question is the Fed looks at everything. You can do that when you have 400 PhD economists. They're watching consumer spending for sure. It's not just holiday spending, but consumer spending in general. But especially nowadays, really especially, they're watching the various indicators of inflation. There's CPI, there's PCE, there's core, there's headline, there are trend means, and a whole lot of things that would bore most people, but have Federal Reserve eyes riveted on the data.
Well, not CNBC viewers. We're all riveted by that stuff, of course. Now, I wonder, how does the geopolitical situation fit into this? There's been a lot of instability, but not perhaps as much aftershock and ripple effect as some might have expected.
If you're sitting on the Federal Reserve Board, you try to and generally succeed in ignoring the political environment. Look, they all know there's an election coming up in November. They probably watch the news as we do. I presume they do, and it's more about politics than it is about the Fed. But when they come into the room, they try to put that out of their mind. And in my experience, now it's many years ago, but I don't think this has changed, they generally succeed. And you don't hear people talking about politics at all. So, I mean, if in particular, what you're thinking is, and many people do think this, is that the schedule, so to speak, of rate cuts might be influenced by the proximity of election, I really don't think so.